Welcome back to Street Science, and the biggest sign of the street today is that mid caps are seeing big outperformance. 4:1 advance decline ratio is what we have. So let's get talking to one mid cap. Vaidyanathan, CMD of Capital First, now joins in. Mr. Vaidyanathan, hi, good morning. Good to have you on the show. Things are looking up again for the finance companies. What's your outlook for the next financial year, for the current financial year that we are in right now? What kind of growth do you expect?
As you know, we are largely the small and medium enterprises space as our key lines of businesses, and we're also giving about a ticket size of 30 to 40,000 rupee loans for purchasing of two-wheeler financing. Now, in my sense, these markets are pretty much large and ever-growing markets. Particularly SMEs will always need financing for a long period of time. So clearly, we feel about a 25 to 30% growth from here should very much be on our radar.
Okay.
We closed last year at about 9,600 crores of a loan book, and we think that should go from there.
Okay. Mr. Vaidyanathan, hi, good to see you in today. You have a strong focus on the retail segment of lending. What makes you so confident in terms of the asset quality within the retail segment, and which are your key clientele that you focus on?
See, first of all, retail for our business over the last 4 years have actually grown from 10% of the loan book to 81%. So to that extent, you're right that we have focused on that. Well, the reason is simple, because it's very stable in its performance, very diversified, and behavior is excellent. And ever since we have substantially improved our retail component, the NP of the company has come down to as low as 0.4% on a gross basis and 0.1% on a net basis. So really, we are focusing on retail for the sake of stability and almost predictability of our earnings.
So within the retail segment, which are the loans that you would be most aggressively targeting, or the segments that you'd be aggressively targeting? You do have a presence in terms of two-wheeler loans, consumer durables. You have even a focus on SME as well as the mortgage segment. So which are the loans that you think the gross NPAs will be the least, will be the most manageable, and where you will focus your energies?
Well, all these three that you talked about are the areas that all of them have our equal focus, and let me say they're all important for us. But in terms of what will move the balance sheet for the company, it's really the mortgages business. That's a big piece. Close to about 6,000 crores of our loan book, or 6,500 crores of our loan book is that business out of the 9,500 crores. About 1,500 crores is the wholesale book. And the two-wheeler book and the durables book are all between 300 to 500 crores. The reason why I said that is that the small businesses, the ticket sizes are small, tenor is short, they don't really build the book. It's just a lot of hard work. But the ticket size in terms of what moves the balance sheet is the small and medium enterprises book. We will focus a lot on that one in the years to come. So
Vaidyanathan, in years to come, say in next 4 to 5 years, are you confident of maintaining this kind of credit growth, 20% plus, while maintaining the good asset quality ratio that you have?
For last 4 years at a stretch, our gross and net NPA have been very stable. So it's really a sustainable sort of a performance that we have done. As I said before, this is a large market. Right now the market is about 61 to 65,000 crores. Of this SME with mortgage as security, that business is pretty large, growing at about 18% to 20% per year. Our sense is that to grow this business at about 25% per year, compounded over the next 5 years, is very possible. And in fact, it has a direct reflection on our profits and profitability, because we feel that in the year FY15 itself, our profits should actually more than double than what we achieved in 2014.
Okay. Mr. Vaidyanathan, what would cost of funds be right now for the NBFC, and what is your sense in terms of cost of funds for the remaining part of the fiscal? Hence, what would the net interest margin trajectory look like as well?
See, for the industry as a whole, if you asked, NBFC industry, probably, well-rated NBFCs of the AA plus, or maybe a little, maybe even A plus, they all borrow in the range of about 11.5 to maybe 11.75. In our case, of course, it's much lesser because of the strong asset quality and capital adequacy over 22%. It's not more than about 10.5% or so. Now, the other interesting thing is that the NCD market, which was pretty much not attractive for the last 5 or 6 months because the fact that interest rates were rather high is something that as we're hoping interest rates comes down over the next 6 to 9 months, that is a new line of funding that will become active. And together with that market and this market and the CP market, we don't borrow much in the CP market, but still all blended put together 11, 20, 10, 25, 10, 50 is the sort of rate that you can borrow at today. And your second question with regard to NIMs, in our case, we are operating at about 5.5% net interest margin. It's very sustainable in the years to come as well.
Okay. All right, Mr. Vaidyanathan, we leave it at that. Thank you very much for taking the time out and talking to us. That's Capital First held their annual general meeting yesterday as well, where they expect the net interest margins to be at around 5.5% expectedly going forward. The stock is currently up around 5.5%. But this is our theme of the day, so let's focus on NBFCs.